Good morning. Today we're going to talk about USDA's Guaranteed Rural Housing Program. I am Rachel Minglecook, the Training and Product Development Manager for CU Companies, and I have put together some of the things that makes USDA different from every other product that we are used to doing. So we're going to go through some of those highlights. I did want to show you that out on our CU Company's TPO website, we do have the eligibility information. So if you click on that, it'll give you a link to the USDA property eligibility and income eligibility. And then we also have those USDA guidelines, and the product matrix is out on the website for your ease. Here's the product matrix. It does include the column for USDA throughout it to give you some basics. So have that available, take a look at it, try to make it easy to cover some of those basic pieces of information on the product matrix. And then there's also CU Company's guidelines for USDA. So these are set up in a little bit different format than what we've seen in our current FHA and VA guidelines, but there's all good information in there. Again, those are available on that TPO website. So one of the first pieces that makes a USDA loan different is the property eligibility piece. The property has to be in an area that has a lower density of homes, and it's set by the USDA. So you can go out to the USDA's website and check the eligibility. Again, if you use the link on the TPO page, I've just got it programmed in here for me. So from this eligibility page, just accept it, their disclaimer, and then if you have an address, you can go ahead and plug that in. I have one that's right on the fence, so we can see what the line looks like. So this is Southern Dakota County in Minnesota. The yellow area is the ineligible property, and the non-yellowed area here is the eligible. So you can see on this one that the address is located in an eligible area. If your borrower doesn't have a specific property in mind yet, you can zoom out and give them some ideas of where they might want to shop if this is the type of loan that they are desiring to have. So as you look throughout here, Minnesota, that metro area, depending on where you're at, some of that, like this is Southern Dakota County, is in an eligible area. That market right around Mankato, Rochester, those bigger cities, St. Cloud up here, are excluded. But pretty much the rest of the state is eligible. So property eligibility and how to check it out. Then we will move on to income eligibility, the other piece of the USDA guideline. So your property has to be in an eligible area, and then your household income can't be higher than what the requirement is for that particular area. So again, we go back out to that eligibility tab. If we click on the income limits, just to give you an idea, it'll bring up that document that I was showing you. You can pick on your state and know that if you're dealing with a property in, just wanted to go to Dakota County to use that same scenario. So we're looking at something in the Minneapolis, St. Paul, Bloomington, that metro area. So we want to be in the moderate income guaranteed loan category. So if you have a household with 1 to 4 persons, your income limit is $84,950. And if you have 5 to 8 persons, you are going to be at $112,150. And it just breaks it out by county. Your GUS approval will also tell you what the limitations are. Okay. So I said household members' income. So that's going to include everybody who lives in the house. So it's key for the loan officer to ask, who lives in your house now? Who's going to live in your new house when you move? So we need to identify all those people, including the dependents, the minor dependents. So you'll need to list out all the children and their ages, anybody else occupying the property. If you have, if there's college-age children, if brother, sister, mother, father, somebody else is living in the property with you, those all need to be identified and whether or not they work. And then we also need tax transcripts for all adult household members, even if they aren't on the loan. And then we do need to do some minimal income documentation for the household members, because that household member income is going to contribute to the eligibility income. All right. So when we talk about household member income and that eligibility income, USDA is using that word annual income. So the annual income for the household is used to determine the eligibility for the program. And for that calculation, we're really going to use a more aggressive figure, the year-to-date, or what do they make now, versus that stable and consistent income that we've used for qualifying. So when we're talking about qualifying income, we're talking about income used for the debt ratio. So the debt ratio is 41 unless you get a debt ratio exception through GUS, and it will happen automatically if it's going to give you one. But for the qualifying income, we're going to use that income that we're used to using. We're going to use that year-to-date and previous W-2 average or a 2-year average. We're going to use that little bit more conservative figure for qualifying income. All right. Then we've got that guarantee fee. So the guarantee fee is similar to FHA's MIP or that VA funding fee, except a little bit different in how it's calculated. So it changes annually at the fiscal year, which I believe is October. So they'll send out a notice in September for what the fiscal year percentages will be for the next year. This year it's 1% for the upfront fee and 0.35% for the annual fee. So on a FHA loan, when you have that 1.75, that MIP, you take the loan amount times 1.75. Well, for this guarantee fee, it's not quite how it works. If we were dealing with a $150,000 loan, you would expect it to be $1,500, 1%. But it's not. So they take 100 minus the upfront fee, which would equal 99, and then divide that into the loan amount. So in this instance, for a $150,000 loan, you can see that the upfront fee is $1,515.15. So that can be financed into the loan, just the cents would need to be paid as part of the closing costs. So then you have the annual fee. So that works just like the annual MIP on FHA, and just like MI, it's 0.35 times the loan amount divided by 12. And it's paid, it's paid and collected as a part of the escrow. The part that's different about it is that it's based on the scheduled unpaid principal balance. So that means if your borrower makes any additional principal payments, that the annual fee is still going to just be based on what the scheduled principal balance was supposed to be in month 12, in month 24, in month 36, throughout the term of the loan. So the annual fee is for the life of the loan. It does decrease as the scheduled unpaid principal balance decreases, but there won't be any difference in payment if the borrower makes a principal reduction payment. Okay. So next we have some eligibility requirements. So like every government program that we have, we are dealing with primary residences. For USDA, they have to be a 1-unit property. They can't be a duplex, triplex, fourplex. We do have a max of 20 acres, as we do on the rest of our government programs, and no manufactured homes. And then the other piece is, even though it's USDA and a rural development program, it's not for ag homes, it's not for farms. So we're still looking for no working farms or income producing properties, just like on every other product we have. Then on USDA, I can't have any other existing USDA loans. If you're familiar with FHA, you know that if you have an FHA loan, you can't have another FHA loan unless you meet some really stringent criteria. It's the same case with this. So for ease, as long as they don't have another USDA loan that they want to retain and rent out and then purchase a new property using a USDA loan, we should be fine. If they do have a particular scenario, there are some very stringent criteria that we can check and see if we can get the loan done still. Right. So next we have some credit requirements. We're dealing with a 640 credit score. I know that's a little bit higher than the credit score that we offer on the rest of our products, being the 620, but there's a couple of behind the scenes reasons for that at this time. We do need a GUS accept approval. We aren't doing any manual underwrites on this product at this time. And then the one thing to keep in mind is that you have to do a manual review of the credit. So those 2 trade lines with a minimum of 12-month history, even if you get a GUS accept, you still have to verify that you have those trade lines. So GUS doesn't review the credit history to validate that that minimum trade line requirement has been met. And they're requiring that to validate the credit score. So USDA is under the impression that if they don't have 2 trade lines with at least a 12-month history, that the credit score that's being generated isn't a true credit score. So just remember that you have to look at the credit report and check those even if you get a GUS accept. Let's see, like every other government program, we need the CAVers. We are pulling a LDP SAM search on the USDA loans, and then there is a 3-year waiting period for bankruptcy, foreclosure, and short sale, and that is to application date. So if you have any of that derogatory credit in the last 3 years, you're going to want to wait to make application until that time frame has passed. Okay, we're going to talk about property a little bit more. We're going to come back and talk about this property piece in just a minute. So the appraisal needs to be completed by an FHA appraiser, and the appraiser has to note that the property meets HUD minimum property requirements, just like on an FHA appraisal. Just to reiterate that they can't be income producing, max of 20 acres, no manufactured homes, and then that they have to be a 1-unit property, so no duplexes, but we can do townhomes, condos, attached single families like twin homes, just as long as it's that 1-unit property. If you do have a condo, it needs to be an approved FHA, VA, or Fannie condo. So back to that LTV piece. So typically when you're doing a purchase, you're looking at the lower of the two, the appraised value or the purchase price. So if I have a $95,000 purchase price and a $100,000 appraisal, on every other product I'm going to base my LTV off of the $95,000. Well, USDA lets you base it off of the $100,000. And by doing that, you can include all of the borrower's closing costs if there weren't any closing, seller paid closing costs on the purchase agreement. So that can come as a great benefit when those seller pays aren't really commonplace in some of these rural areas. On the flip side, though, if the appraised value comes in lower than the sales price, we're going to use the appraised value and have to, come in with that additional money. So that's one very unique piece to USDA. Okay, so as a correspondent partner, you have 2 different ways that you can do these loans with us. One is you're already an approved lender with the USDA, so you already have your GUS access. You've probably been doing these loans with other investors, and you're familiar and know how to do them. So you'll run GUS, you're going to update GUS, you have the communication with the USDA to obtain the conditional commitment. We will assist you with the income calc for the 355521. We'll just do those couple of income pieces and upload them to the file for you. Now, if you're a sponsored agent, so you're really a sponsored agent of CU companies, we set you up with access to run GUS in our system. So since you're running it in our system, we have the ability to update it. And since you aren't an approved agent, or sorry, an approved lender, we have the communication with the USDA and obtain the conditional commitment. Okay, so just a quick rundown on file flow for approved lenders. So you're going to submit your loan like you usually do into the TPO website with your GUS. CU companies will do their underwriting, issue that conditional approval, ask you to update your GUS if there's something that we wanted you to change. You will obtain the conditions, resubmit them back into the TPO website, and it'll go back into underwriting for review. So we will clear all the conditions except the conditional commitment, which we leave as a prior to docs condition, and calculate that income for the 355521 for you. Then you get to go ahead and send it to the USDA and get the conditional commitment since you're the lender. And then once you have that conditional commitment back in, upload it to the TPO website and we will issue the clear to close. So we will be reviewing that document on the last page for any potential additional conditions that you may need and add those as closing conditions. Okay, so if you're a sponsored agent, so you don't have that communication piece with the USDA. So in the beginning, your account manager can run GUS for you, but we'd like you to be set up to run GUS. You'll have to do the GUS training and then certify that you did the training, and we'll send it in to our compliance department and get you set up in GUS. So then, again, like any other loan, you run the GUS, you get your loan submitted to the TPO website, it gets submitted to underwriting, underwriting will review it, and if anything needs to be updated in GUS, since it's in our system, we can go ahead and update it. And then we'll issue you the conditional approval. You get the conditions in, it comes back to underwriting, and we will sign off on everything except that conditional commitment and then prepare the 355521 for you. From that point, that 355521 needs to be signed by the borrower, so we will upload it to the TPO website, send you an email that needs to be signed, and then once you get it back, the account manager takes care of submitting all the documents to USDA for review, and they can also check the turn time and have that communication with you for what is the expected turn time out of the USDA office. Depending on the location, it's been as quick as 24 hours and as long as 3 to 4 days lately. So, but we can check on that for you. So the USDA will issue the conditional commitment, we get that uploaded back into the file, and then get you your clear to close and you're all set. The one thing to remember is these loans do close in your name and they can't close before the conditional commitment is uploaded. So we are at the mercy of the USDA. So that is a brief overview of that USDA product and what makes it different. If you have questions, you can reach out to your account executive, account manager, or use that Ask the Underwriter email at underwriting@cucompanies.com. So thanks for your time today, and we look forward to talking to you in the future.